Hello and welcome to Blue Chip Now, the podcast that gives you insider access to content that we tailor specifically for our clients. Whether you're climbing the corporate ladder or just seeking smart, efficient intel, we've got the answers to your most pressing financial questions. Join us as we break down the markets, debunk the headlines, and keep you ahead of the curve. Let's dive in. Hello and welcome back to another episode of Blue Chip Now. You have Daniel Dusina, Chief Investment Officer.
And Matt Mondoux, Senior Financial Advisor.
So we usually record these on Mondays. I wish I could say we're recording this on a Friday because of all that's happening in the markets, but it's actually just because myself and one of our esteemed producers will be out on Monday. So it is timely, however. So recording this Friday, March 6th. So the items we're going to cover today are very much well publicized, but I think it's important to provide some color, context, and overall commentary on kind of our thoughts on a few different topics. So we'll start with Middle East tensions and what's going on in the oil market. We got a U.S. jobs report this morning, so we'll be talking about just the general state of affairs in the labor market and what that means for potentially the Federal Reserve and interest rates. And then we'll kind of close out with artificial intelligence trade hitting volatility on an ongoing basis.
So, Daniel, this all sounds great, but when you told me March Madness, I thought we were talking college basketball, not markets.
It's, just never say never. So even though we will get the tournament starting up here soon, not to be outdone is financial markets as always. So all right, let's start with Middle East tensions and the oil shock that we're seeing. So very clearly, the biggest geopolitical driver for markets recently has been escalating tensions, specifically with Iran, but more specifically around the Strait of Hormuz, which is one of the world's most prominent oil shipping routes. Roughly 20% or so of the global oil supply passes through this narrow channel. So when markets have started to price in the possibility of disruption involving Iran, energy prices are, of course, moving very quickly. So right now we've got oil prices that are surging above $80 per barrel, and that is triggering a chain reaction across financial markets. What do higher oil prices mean? I mean, higher transportation costs, higher inflation risk, and all that points to potentially fewer interest rate cuts from the Federal Reserve. So the immediate response that you've seen has very much been focused on energy to the upside. So you've seen energy stocks rally higher, while sectors like airlines, travel, consumer discretionary, all of which do rely on big oil in some capacity, have sold off. The volatility then kind of has hit the broad market indexes at scale. So you've seen a couple of sharp down days throughout this week. Even if you have seen some recovery, there's clearly volatility evident. And for investors right now, I think this is continuing to be about inflation risk and specifically as it pertains to energy markets.
It's amazing. I did a double take this morning reading about oil. Oil was up pretty sizably today. And it's the price of barrel of oil is actually up over 50% year to date, which just shocked me. We follow these things, but to see a 50% move, it was pretty surprising.
Yeah, and I think it's interesting too because if you remember back to, let's say 2 weeks ago, there was still the potential threat of disruption in Iran, but you did not get investors pricing like it was going to happen. And that really didn't happen until you truly saw the event start to unfold over the last weekend. And what I think is interesting now is that it's obvious that disruption on the supply side is going to impact prices and move related stocks higher. But one thing that I found interesting, a friend of mine who I'm not going to name, but he works in foreign exchange, sent me a bit of a contrarian take on some of this stuff, which I found interesting. And it's specifically related to one of the other knock-on impacts of this. He sent me this tweet from a guy that said, the Hormuz closure is not a 6-week oil price shock. It's an 18-month stress test for the global food system. Most allocators are trading the obvious, oil up, defense up, gold up. They're missing the connective tissue. And what he followed on with that by saying was that 1/3 of globally traded fertilizer transits through Hormuz. So basically what he's implying is that if you were to get this fertilizer disruption, that could cut places like African food production by 20%. So, and this is not to specifically call out that as an example. It's more conceptually I think investors over the next week are going to start to think about what are the true knock-on impacts of this that are not just one-for-one oil prices up, energy stocks higher.
Yeah, what has not been priced in yet.
Right. So I think that, obviously continues to be front and center, especially as, I think our administration has been very, very, very front and center on social media, putting out content and all that sort of stuff. So,
well what this says to me, we mentioned inflation in the energy markets, but could this be inflation elsewhere? And then if so, I think our next point is going to talk about how complicated the path forward is with rates, or we're going to start to paint that picture.
Well, yeah, and I think you already had the Federal Reserve already had a challenging job, and it just continues to get more complicated. So this morning we got a surprisingly weak U.S. jobs report. Instead of adding jobs as expected, the U.S. economy, per this report, lost roughly 90,000 jobs in the month of February, while unemployment ticked up to about 4.4%. So if you'll think back, the last 2 months were actually surprisingly good job numbers that kind of got released. And so I think coming into this year, I did have a little bit of fear around higher unemployment rate, relatively stagnant jobs market. And the last 2 months served to quell some of those fears. But realistically, we're kind of back where we were in the fourth quarter of last year, which is generally softer and starting to be a little bit concerning. So for markets, of course, that's creating this complicated narrative where, you've got markets trying to answer one question: is this truly a start of an economic slowdown, or is this a temporary soft patch? And the Federal Reserve is trying to figure out the same thing because of the push and pull of inflation right now. I think coming into this year, rate cut expectations were around 2. But if you get inflation running hotter, it's a lot harder to reduce interest rates by 50 basis points to counteract some labor market weakness if prices are charging higher.
Yeah, I mean, this is the definition of between rock and hard place. So yeah, I think the path forward for the Fed is going to be challenging. I think the markets are going to have a tougher time digesting what path the Fed could take. Yeah. This is no longer the kind of the environment of old where inflation low, unemployment, trying to get to full employment. You could arguably have 2 fires going, and the Fed has to figure out which one they want to put out.
Yeah. Well, if I can give one piece of positive insight to push back on the surprisingly weak jobs report, it is worth noting that there was a meaningful degree of weakness in the leisure and hospitality portion of the economy. And keep in mind, there were 30,000 workers at Kaiser Permanente in California that were on strike last month. Mm-hmm. So there is always going to be some artificial pull down or push up in these jobs figures. So you can't necessarily take them explicitly at face value. And instead, I think you have to kind of ascertain where is the structural weakness, and is this to be expected for the foreseeable future?
Yeah, I just think the market movement more just illustrates or starts to paint the picture of what you could expect should this start to play out in a more meaningful way. Like, by no means are we saying we have a weak economy. I think we feel the opposite of that. But, should this be the start of a trend, you can see that the Fed, could potentially, between the conflict in Iran and, weakening economy or weakening employment, could have its work cut out for it.
Yeah, 100%. So switching gears back to the equity market, we've talked a lot about geopolitics today and economic impacts today, but realistically, you're having this AI trade, arguably the biggest market theme over the last 2 to 3 years, has gotten a lot more volatile. And you've seen that not just, in recent trading days on the back of the geopolitical disruption, but really year to date, starting in the end of last year, actually. The poster child here remains Nvidia, which has been the key bellwether for AI spending across the tech sector. But over the last several weeks, we've seen some large swings in semiconductor stocks as investors debate what I see as 3 questions. Number 1, is AI spending still accelerating? Number 2, are valuations getting too stretched? And then finally, number 3, are big tech companies starting to slow infrastructure investments? So because companies like Nvidia, along with other mega cap tech names, make up such a large share of indexes like the NASDAQ and the S&P 500, these moves are going to essentially amplify the impact at the index level. And in many recent sessions, AI stocks alone have determined whether the overall market finishes up or down. So continues to be that theme that we see. And again, like we've highlighted the fact that you've seen equal weighted indexes and value and small cap be meaningful outperformers of your call it traditional poster child of performance. That trade has kind of continued, and it does remain to be seen when investor scrutiny on some of this capital expenditure program and profitability is going to cease.
Yeah, I think the comps get really tough to beat. When you are predicting revenue increases and sales the way that these companies are, eventually that bar gets really tough to clear. The other thing I found very fascinating this week, we get some heightened volatility is the within the market, some of the stock moves. And I've been talking about, generally speaking, and traders will borrow on margin. So they'll borrow in addition to what their portfolio value might be worth, and they'll leverage that and buy more stocks. Now, this happens during periods of strong bull markets. And I feel like we're seeing evidence of maybe that margin unwinding this week. And I'll point to a couple of things. The stocks that have been up the most, so in theory, the ones that traders are going to leverage and buy more of, were down the most, whether that be memory chips, semiconductors, AI infrastructure stocks. But then also what's been more interesting is, what I couple with that is software stocks, U.S. software. U.S. software stocks have actually been positive in some cases, largely. So the market could be down 1%, software might be up 2%. And what that tells me is, that is also traders maybe covering short positions. So as we know, U.S. software companies have been under pressure due to AI, artificial intelligence, potentially being able to cannibalize their markets. And we're seeing those stocks go up. So I feel like so far this week, we've maybe seen like a lot of trader movement.
Yeah, without a doubt.
And it's still tough to decipher kind of what the, if this is more economic or more traders looking to de-risk their portfolios due to some uncertainty.
Yeah, no, I think that's a great point, because what you are seeing right now is a very technically driven market almost, right? So, great example of this, Intuit, which came dramatically under fire under the whole artificial intelligence is going to replace their business.
Right.
Up 30% off of February 24th bottom.
Right.
So you are seeing that kind of, call it positional rotation trade happening. Would argue that has nothing to do really with fundamentals. It's more either sentiment or, quite frankly, position unwinding.
And you do see big moves like that with short covering. Yeah. So, and that's where, short covering, for people who don't know, people are betting against the stock. They've actually betting it to go down. And when the stock starts to go up, that hurts the short seller, and they end up closing their positions out.
Okay, so we covered a lot of ground today. I'll recap briefly, but Middle East tensions and rising oil prices, very front and center. A weak U.S. jobs report and rising inflation, continuing to make the Federal Reserve's job challenging. And then closed out with some volatility in the artificial intelligence and related spaces. I do think, I'll close by saying this. You alluded to March Madness, and, volatility can come at any time, and it can come off of any catalyst, and sometimes there isn't a catalyst. We know what the catalyst for the volatility has been this time. And even though it's not like you can point to an explicit end in sight or easy resolution, this is nothing new for financial markets. There will always be a soup du jour. There will always be cause for concern. Positioning is important, but staying the course is arguably more important. So we're here to talk if you have any questions.
Agreed.
All right. That's all for now. Thanks for listening to another episode of Blue Chip Now. We look forward to speaking with you again soon.